Hello everyone. We have a bit of a one-off for you today on Portfolio Matters, talking about the issues arising from the historic Greek debt restructuring and the situation there currently. Just to make clear, we're not talking about any individual stocks today. There'll be a full disclaimer at the end, but no need for an initial disclaimer up front. So Keith has been highlighting in the previous few Friday Portfolio Matters episodes about the peripheral yields in the Eurozone and the possible emergence of the early signs of another Euro crisis. And he did a talk a few months ago about the Euro crisis and what risks there are of that returning. So when I saw an interesting piece by Adam Tooze, I thought I'd summarize it and present it on Portfolio Matters. So this is very much Adam's work, and we're going to present it and talk about some of the issues that it raises. So as Keith's been pointing out, there has been a rise in peripheral Eurozone yields. It used to be the pigs, but I think Spain has now got itself out of trouble. So it's now more like the GIPs, Greece, Ireland and Portugal. And amongst those three, Greece, of course, historically suffered an actual crisis and a big debt restructuring. So their yields on 10-year bonds are now touching about 2.9%. Ireland's actually still fairly restrained, 1.4%, Portugal 1.7%. So in the context of the yields that these bonds reached during the heights of the crisis, this isn't anything too bad, but it's going up, and the spreads versus Germany are also going up. So are we about to go through another Greek crisis?
One thing I'd add, Stuart, is that the country I'm most worried about in the Eurozone is Italy, which strangely isn't on this chart from Yardeni Research, but its debts are the second highest in the world compared to, excluding Greece, after Japan. And if there's a crisis in Italy, then it's the Italian bond market is too big to be saved by the ECB.
I think it's a very good point, looking through the Greek experience and seeing how much of it could even be replicated in Italy. Is it possible? But yeah, let's circle back to that later. So the current situation in Greece, following the debt restructuring, the vast majority of Greek government debt is actually held by intergovernmental institutions. It's not particularly freely traded. There isn't a strong private market. We've really got to understand this is between the Greek government and historically the IMF and the European Union. So that means, to a large extent, it's not market forces that initially will determine the sustainability of the current situation in Greece. It's all going to be political. Now, we saw on that 10-year yield chart that Greece was paying, I think, what was it, 2.4%, 2.9%. But actually, when you dig into it, according to Adam Tooze, Greece is actually paying 1.4% on its loans. There's various waivers, various exemptions, various reclassifications, which mean the reality isn't even as it appears in the market. Greece has also recently repaid the IMF, and that's the last of the money that they borrowed from the IMF. And this was the expensive debt that the IMF would not overly subsidize, in contrast to what the European Union was prepared to do. This payment of the Greek debt was supposed to be in proportion to the amount of debt that was issued by different creditors, but in fact the ESM, the European Union mechanism, waived its right to be repaid. So the IMF has got its money back. It's done. It's out. So which further reinforces that it's the link between the EU and Greece that's important. Greece has actually had not too bad a crisis, a COVID crisis, I mean. There was not the same pressure on Greece to impose austerity that you might have expected. And in some respects, they've actually been quite loose, fiscally loose, during the COVID crisis. The chart on the left shows what Adam Tooze was classifying as above the line government support at about 14% of GDP, at the highest within the EU. So this is things like direct payments to companies and to individuals. The chart on the right looks at the situation more broadly, also including off-budget guarantees, things like sort of debt guarantees that the government might offer to businesses. And there Greece is less of an outlier, but still it was able to offer quite a lot of support to its economy, its citizens, its businesses during the COVID crisis, despite the high level of debts that the country already had. And putting that into some hard numbers, the table here, again by Adam Tooze, was looking at the primary balance that was expected in the Greek budget. 2019 was 3.7% primary budget surplus. That was forecast to remain around 3% in 2020 and 2021. But actually, there was a massive budget deficit due to all the COVID support measures, such that the primary balance actually came out as more like minus 7% of GDP. So approximately that figure can be added to the stock of government debt, pushing the debt to GDP ratio yet higher. Now, some of that was automatic stabilizers, things like unemployment benefit, but the largest chunk was actually discretionary measures, about 8% of GDP. So Greece hasn't actually had to impose too much austerity during COVID. It's been able to support its citizens. But as we say, that has added to the stock of debt. Now, there's a slightly complicated chart here, lots of different grey and black lines. The accumulating grey block or line over time is the debt to GDP ratio, which we can see, for instance, in the 90s, in the run-up to the launch of the euro, was held at roughly 100% of GDP. That then shot up. I'm not sure how much of this is the numbers as were presented by Greece at the time and versus what the numbers have been subsequently recalculated to be, because obviously the Greek debt crisis happened and all the fiddling of the figures could no longer be continued. So the last couple of data points, we see debt to GDP in Greece continuing upwards, so now reaching about 250% of GDP. So that's the stock of debt that Greece still has to support, despite the write-offs during the debt crisis. So why are the bond yields actually so low relative to what you might expect given the debt load? Well, it's back to this point that the vast majority of Greek debt is in public hands. It's not privately traded, it's not privately negotiated. And the ECB has been buying pretty much the entirety of new issuance under the PEP program. Now, this, of course, is in sharp contrast to what precipitated the Greek debt crisis, when even when Mario Draghi said he would do whatever it takes to support the euro, that didn't apply to Greece because Greece didn't have an investment grade rating. It still doesn't, but now the European Union, via its mechanisms, is prepared to buy the debt. So to some extent, we don't know what the real yield on Greek debt would be if it was freely traded. It's basically a function of politics. So reinforcing the story about the current situation in the Greek economy, there has been efforts by the European Union to help the growth prospects of the country. And there was established by the EU a next generation recovery fund. And Greece has actually been a very big recipient of this. We can see in the chart on the bottom left that it's been the third biggest recipient of these grants from the EU. So there is some effort to try to put the Greek growth path, to nudge it upwards via this support money. But turning back to the path that Greece has been on since the debt crisis, this was quite a shocking chart that Adam Tooze produced, which really shows that the Greek economy has suffered well beyond perhaps what we've realized. Now, it's a slightly complicated chart, but just looking at the green line is the US experience of the Great Depression in the 30s, where GDP fell by 30% before recovering. And that was a sort of round trip which took about 7 or 8 years. Now, we all know that the pain that the Great Depression caused. But if you compare that to the experience that Greece has had, Greece has been suffering far worse. It too suffered about a 30% fall in GDP, but there hasn't been the sharp bounce back that there was even in the Great Depression in the States. So if you think of the area between 100 being the GDP level and the line in the chart producing the reduction in GDP, if you think of that area under the 100 line as being the amount of pain, then it's just so much more for Greece than it was even in the Great Depression. And frankly, the Asian crisis looks fairly minor on this comparison, where GDP fell, looks like about 8% before bouncing back within 3 years, back to the initial starting level.
I'll just make the point, though, Stuart, that this chart is GDP per capita. And we've talked previously on the weekly about how the drawdown in Greek GDP has been absolutely astonishing. It's been about 40%. And you see on this chart, it's much less than that. And that's because it's GDP per capita. And there's been a lot of net migration, sadly, from Greece because of the crisis. And so you've had a shrinkage of population, which actually rather flatters GDP per capita. So if you move on to the next chart, you see that GDP in total has fallen by about 40%.
Yeah, that's a very good point to make, Keith. I mean, and presumably it's the best and the brightest, those who can't leave, who will leave. So you've affected your growth potential longer term. Right. So what is the outlook then for Greece and its debt situation? Well, so again and again, we're coming across this story where actually the IMF and the ECB and broader EU institutions are not trying to turn the screws. They're actually, at the moment now, trying to adopt a path where Greece can sort of muddle through and society can be protected. The IMF warned that the fiscal adjustment that Greece still needs to go through to reduce that 250% debt to GDP, the fiscal adjustment should be gradual and growth friendly. They say plans for permanent cuts in social security contributions and in the solidarity tax for all taxpayers should be reversed, as they shift the burden to future generations and are poorly targeted, or at least fully funded through benefit adjustments, retrospectively based broadening measures. So the IMF is not trying to sort of turn the screws, and it's trying to enable society to put up with the fiscal adjustment. However, there's a degree of Alice in Wonderland going on here underneath all the projections for Greece's debt to GDP reduction. There's a plan, but it relies on a continuous primary budget surplus of over 2% of GDP. It relies on a continual growth rate, and it requires debt financing costs not to change. And if you can assume all those different things, then Greece can get its debt to GDP ratio within Maastricht limits by, I think, 2060. So if you allow the compounding effect of two different growth rates, i.e. the economy growing faster than debt, to play out for 40 continuous years, then the plan will work and debt to GDP will come down to the required level. And just to look at one piece of evidence about how likely, how plausible this is, there's a table here showing the number of instances where any country has run a primary surplus of over 2% of GDP for over 40 years. And there's basically only about 8 of them. And this includes examples like Norway between 1975 and 2014, when presumably all the oil money was coming into the country and supporting the budget. There's a few other instances, Denmark, Finland, Canada, but basically the point is that it's going to be very difficult for any country to continuously run a primary surplus of that degree. And that's just, I think, one example of the difficulty and the implausibility of this 40-year plan relying on growth outpacing debt servicing costs, and the government able to control its own fiscal spending to reduce a budget surplus every year.
Yes, I think the point about this plan, Stuart, is this is a political plan, not an economic one. It's economically implausible, but it gives the EU cover to continue their stimulus program to Greece. So the EU are essentially saying the Greeks are in this program, which will get them down to 60% debt to GDP, no matter how implausible that is. And because there is this pathway, then the EU can continue to continue their stimulus measures.
Yeah, absolutely. They know the answer they want, and these are the only variables to put into the equation to produce that answer.
Yes, very well put.
Yes. So turning to one measure of the implausibility of this plan, there's a chart here showing the primary balance that Greece has achieved since the Second World War, where we can see that continuously until about 1990, Greece never ran any primary balance, positive primary balance, let alone a 2% primary balance. Though it did do so in the run-up to the creation of the euro. It did have, I think, how many years there? About 8-9 years of a primary budget surplus before relapsing back into the traditional deficit, which then, of course, became extreme during the run-up to the crisis. So this is just one example about how implausible the assumptions going into that growth projection are. But of course, as Keith said, it's a necessary fiction to enable the ECB to continue funding Greek debt issuance. This chart, I think, is pretty shocking. Adam Tooze was pointing out that real GDP per capita in Greece has collapsed during the crisis from about 65% of the German level to about 45% of the German level. And now that sort of hit to living standards, hit to GDP, is this politically sustainable? Can the Greek population put up with that sort of a situation for the required period of time? And I think Keith's point about the read across to Italy is so important here. If Italy had a similar crisis, would it be prepared to belt tighten, to go through austerity, to do all the things necessary to get its fiscal house in order, and it to remain within the euro? And I think that the Greek experience suggests that, well, actually, people have been prepared to put up with it in the absence of a viable alternative and not wanting to go through the chaos of leaving the euro. But this does illustrate the sort of price, the cost that a society would have to put up with if it does go through such a crisis. So in conclusion, Greece has a debt sustainability problem, but it's mainly a function of politics and not of economics. It's the public institutions that hold the vast majority of the debt, and it's their continued willingness to buy fresh debt and to extend and pretend that is keeping the show on the road. For the moment, that the show is on the road, and the ECB has been acquiring all the new debt that Greece is issuing under the PEP program. So watch out for politics, if there's a change to EU policy, then Greek debt would very quickly become unsustainable. And I would add to that, have a real think about whether Italy, for example, would be able to go through the sort of transition and adjustment that Greece has had to suck up. It could really lead to a big unraveling. I think, well, it's back to the question that Keith discussed in the future of the euro podcast a month or so ago.
Yes, thank you for putting all this together, Stuart. When we talked earlier about the big fall in Greek GDP, that is responsible for the Greek debt to GDP ratio going through the roof after the great financial crisis. Is not been a huge increase in Greek debt. And the other thing I'd say is that Greek debt sustainability is very much a function of politics, and that when the Eurozone was set up, it was explicit that there were not meant to be fiscal transfers between Eurozone participants. But the reality has been that there have been. The ECB has been buying 100% of Greek debt under the Pandemic Emergency Purchase Programme. And so implicitly, there have been these fiscal transfers, and those can continue as long as the ECB runs zero rates and QE. So it's buying loads of periphery debt. Now, you'll be aware that the Eurozone now has inflation of about 7.5%, but its base rate is zero and its deposit rate is minus 0.5%, and it's still doing the asset purchase plan. Now, if it were to raise rates and stop doing QE, then it will have to stop buying Greek bonds. And so those implicit subsidies would have to end. And would they then be replaced by explicit subsidies, which would rather go against the initial spirit of the Eurozone? And these questions would then become real. So I think this is not really an economics problem. It's a political problem for the Eurozone. And one we'll just have to wait and see how they craft a solution. But I mean, what's been amazing is they have crafted a solution throughout. And the Greeks have put up with a lot of pain to stay within the Eurozone.
Yes, that they have. It's a very good point about debt to GDP going up because the GDP has gone down. Yes, I haven't quite appreciated how much it's been that part of the equation. It just brings back to me the presentation you made recently about the euro, possible return of the euro crisis, and going through this example of Greece. It does make me worried that that Italy is, as we highlighted, too big to fail, and yet the price that you might have to pay to continue to fit within the euro structure is so painful that can any society put up with that, or will they pull the ripcord even if there appears to be very high costs? Absolutely.
Well, we remember when Greece went through its crisis after the great financial crisis, how there were the rise of these right-wing Golden Dawn parties, etc., in Greece. But Greek society seems to have adapted. It's never. You look at the fall in GDP, you would think that Greece would have fallen out of the Eurozone, but it hasn't. It's put up with the pain. Okay, I think that's it. Thank you all for watching, and thank you very much for Stuart Owen for dialing in from Tokyo with this presentation. So I hope you'll all press like and subscribe to the channel. And in the meantime, it's goodbye from me, Keith Jordan.
And goodbye from me, Stuart Owen.
Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.